So yesterday I mentioned that we were bullish, so we're starting to look more bullish, but we're still missing a few signs here and there. Today we got a few more bullish signs, so I'm going to show you what those were to see how that impacts the expected intermediate trend going forward. How did this Iran deal news impact investor sentiment, if at all, and what sectors and asset classes did it impact the most? And then out of all the sectors that are turning up as the market turns up, I'm going to focus on one sector that has been lagging behind that showed some relative strength today for a trade idea. So let's go ahead and get started. Today is Tuesday, May the 8th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for watching tonight. Welcome to those of you watching us for the first time. Glad you found us. Keep coming back for more. Subscribe to our YouTube channel by clicking on that red subscribe button down below the video. You can also see it by mousing over the Market Scholars logo in the bottom right corner of your screen, then clicking on the red subscribe button. Hit the thumbs up icon down below the video. That lets me know, number one, that you like today's video. Number two, you want me to do it again tomorrow. Also, comment on anything that stands out to you from today's video. You'll see the comment section scrolling down below. And then finally, join our Market Outlook daily email list. You'll see a link in the video description to be able to do that, as well as a form if you're on our blog post to be able to subscribe to our list there. Follow me on Twitter for more content throughout the day, throughout the week. My handle's on the top of the screen at DavidSettle42. Like and retweet tonight's Market Outlook tweet, always pinned to the top of my timeline. Join our Market Outlook community. We're over 1,000 people strong there. You'll see a link. You'll see the address at the top, as well as a link to join down in the video description below. All right, well, let's take a look at the S&P 500 first with the market forecast indicator. You can see that intermediate line trending higher towards now the 60th percentile at 59.37. It's rising. Near-term line's falling, but up in the reversal zone, so that's all that matters. And the momentum line's falling too, dipping its toe under the water in that lower reversal zone. So that, by definition right there, is what's called a bullish intermediate confirmation signal. We have a strong bullish or a strengthening bullish posture. It's at least above 50. Now, the ideal intermediate confirmation signal, at least bullish one, is when you have the intermediate line above 80 already. You've got a strong bullish posture, and then you get the dip below 20. So as long as it doesn't fall below 5, that's the extreme lows that we don't like to see. If it drops below 20, just like that, would be perfect if the intermediate line was above 80, and the other thing that would be most ideal would be the near-term line also below 50. Considering the near-term line's only a couple of days above 50, in fact, it's what? Here we have 1, 2, 3 days now of the near-term line being above 50. The typical pattern is 7 to 12. Now, we are not up above quite yet the old high point. So you can see there's the old near-term high. We're still holding. That lines up with that peak right there. Still holding that for resistance. So we haven't quite broken up above that to where we'd really be. And then that would be the next near-term peak that would align here with this one, this area where we crossed up above 50. That's got to that near-term peak. And of course, before that, you can see it was back over here. So we had a higher high before this kind of pullback that we've had. So, but we are up above an upward trending moving average. That's why it's green right there. Slightly trending higher, but at least it's trending higher. So slightly higher, and that's a positive development still for the posture. So not as bullish as we'd like it to be. We'd like to get above that near-term high. That would be the most ideal. But considering this bullish pullback posture, or this bullish pullback signal that we're getting, this kind of short-term, very short-term buy the dip signal, we might be able to get that bounce and push through as early as tomorrow on the broad market as a whole. The Dow Jones Industrial Average looks very similar. You got the same bullish intermediate confirmation signal. Not quite as high on the intermediate line, but at least it's above 50 now. So that's a good sign. Not above the previous near-term high yet either. So again, but you still have that bullish intermediate confirmation signal. It's not the best because of where the intermediate line's at, but it still is by definition an intermediate confirmation signal, a combination of an oversold momentum line with a bullish posture. In this case, especially bullish because it's at least above 50th percentile. These kind of signals here are worthless. These kind of intermediate confirmation signals because the intermediate line's below 50, right? At least it's rising and it's above 50. You take a look at the Nasdaq Composite. Its intermediate posture is, well, it's above up to 70 now. Same bullish intermediate confirmation signal, so a positive sign there for that. And the near-term line entrenched in the reversal zone, and it is above its previous near-term high. Not quite above that one, the one prior, but still, it has broken out of its triangle. It is further above the moving average. And then finally, the Russell 2000, same thing, also above that previous near-term high. Not quite above that initial one yet either, but you can also see too how it's starting to make its run up above. However you draw these lines, right? So depending upon how you draw these lines, the best fit scenario here, you might want to activate that and raise that up just a little bit. But trying to get across these highs as best as possible. You can see how we had got up there yesterday to the line, and today getting slightly through it. The intermediate line's the strongest bullish posture we've had out of all of them. It's up to the 76th percentile. Less of a pullback on the momentum line, as we didn't really get a pullback today as much on the small cap index, and the near-term line just entrenched in that reversal zone, coming off of a bullish low point. Where the near-term peak is between 20 and 50, and now getting up above 80, a positive sign for this new intermediate trend that we're on, well up above what is now a rising 36-week moving average there. As always, a quick reminder for those watching the video on the Market Scholars blog here, if you scroll down below the video, let me know that you want me to keep doing these videos, me and Brandon. You want us both to keep doing these videos day after day, and you can do that with 3 clicks. One is to like it here on Twitter. Number 2 is to like it here on Facebook, for those of you who have those 2 accounts. And the third one is to like it here on our blog. Remember, you can also share this with others by retweeting it with that link there on Twitter, and then sharing it there on Facebook. Remember, it doesn't matter, if you have many followers or not. The fact that you are liking this helps me. But first of all, it tells me you want me to keep doing it, because it shows me that you do like it. And number 2, it helps me in that it shows Twitter and Facebook that this is engaging content that they should promote. And number 3, it also tells Twitter and Facebook that you want them to keep pushing you all of my content as we get more and more content out day after day on these social platforms. They're not going to show you everything, but they will show you stuff that you engage with regularly. And so the more you engage with these tweets and posts, the more these social platforms will keep pushing you our stuff. Of course, looking at the long-term charts here, you can see the 50 and 200-day moving averages represented by a 10-week and 40-week exponential moving average on the S&P 500. I see that we got the green arrow. We're still up above that 50, and I still believe we'll get above that 50. Whether we'll get to new highs, all-time highs, remains to be anytime soon is doubtful. I mean, eventually, probably yes. Of course, we always do eventually. But anytime soon, I don't think it's doubtful we'll get up to new all-time highs. But we'll get up above that 50-day moving average far enough to start bringing it higher and bringing the MACD up a little bit too. Again, I don't think we'll bring it up to a new trend, but similar to these dips and rallies we saw on this downtrend over here, that's something I can see happening again as we kind of move our way back over towards these peaks on the S&P 500. When you look at the 3 green arrow chart, you see we got 3 green arrows. We have, we're above the moving average, just barely, but we're above the moving average. The MACD is showing a green arrow. The stochastics is now close to crossing above the 50th percentile. That's one of the things we were missing yesterday. It's rising and now close to crossing up above there as well. You can see similar patterns in all of the indexes here. There's the Dow Jones Industrial Average. Here is the Nasdaq Composite. You can see strong, even stronger. This one is up above, coming off a phantom green arrow, and the MACD is looking strong, and we're easily above the moving average. And then finally, the Russell 2000, you can see again a stronger stochastic, MACD easily above 0, up above a rising moving average. So 3 green arrows across the board for all the major indexes right now. You can see on the intraday chart, we did get a lower high and a lower low here. We tested the 4-week midpoint. I did mention that here on Twitter And again, look at that. We're getting over 100 likes. So I do appreciate those who do like and retweet the Market Outlook tweet. Like it says, it goes a long way for me with Twitter, thinking that this is engaging content that they should promote to other people that check this kind of stuff out. But I did post this right after that nuclear deal came out, that we did come down, looking at that 4-week midpoint for a support level. And you notice that we ended up bouncing off of that 4-week low point and rallying back up above yesterday's low, in the middle of yesterday's range, pretty much towards the middle of today's range too. So pretty neutral candle, but you can see still in the top half of the 4-week range here. So positive development from that regard. There's what it looks like on the 20-day chart, or if I move to the 10-day, kind of a smaller time frame. To see it a little bit better, you can see over the last 2 weeks, easily trading in the upper half of the last 2-week range, and closer to breaking up above those highs than we are coming anywhere close to the lows, which, remember, now are down at 259. We were just there a few days ago, and that quickly we can change sentiment on a short-term basis. Now, if we take a look at the today's volume, you can see the volume is still light, coming in below the 4-week range here. There we go, 67 million. You can see how that 4-week range in gray continues just to really push its way down. That's 1.5 times the average volume up above that. If I were to zoom out a little bit more, not on the weekly, but look at it on a daily chart, so you can kind of see this gray line and where it's at. You see how this continues to point down. And you take a look at other indexes like the volatility index here. There we go, the VIX. You can see on an hourly basis coming off of a lower high point right now, with the stochastics coming down below 50. MACD is coming down, almost crossing back below 0 in the histogram. This would be obviously a much lower high point. We're already down below 15. For the VIX, so volatility continues to fall on an absolute basis. You can also see too on a relative basis, staying below the neutral zone. This is the bullish area, so we're still kind of tenuously in the bullish area for volatility, but we're definitely below 90%. It's a positive sign so you have trading ranges, and you see that here, the ATR. Excuse me. Still getting used to all these charts here, these great charts that we have put together for Market Scholar clients here, and I'll just get rid of some of these other indexes here, and just want to look at that ATR by itself, and you can see how it continues to press its way lower here. Let me change that to a 5-year weekly. There we go. See how it's pointed down. So volume's pointed down, volatility is pointed down, trading ranges are pointing down. Those are all positive. Usually we don't drop coming down while these are coming down, and they grind their way down for long periods of time. Of course we can always go back up. Of course, anything can happen. We can break through that support for any odd reason. But from a technical perspective, when those things are falling, they tend to fall for a while. And we tend to bounce. We tend to rally as they're falling. That's generally how that correlation works. So one more chart I hadn't shown you yet is the 3 green arrow chart, but with all the lines there. And again, you can see now the 8-day is crossing above the 17, just barely, and that's why the MACD in blue is just barely above 0.4. But it's also above its moving average. Stochastics almost above 50, but above its moving average. So, and we're still holding this downward sloping trend line. So, in summary, we still have, a bias towards the upside, but we still don't have the breakouts that we need, whether it's that near-term peak here that we already have broken out on the NASDAQ and the Russell, or a downward sloping resistance line, which remember we already have broken above on the Russell 2000. So we're getting more confirmation. It's coming slow, but that still puts the bias, at least in the intermediate term of the next 1 to 3 months, towards the upside. So what do you think? Do you agree or disagree? Let me know with that poll that just popped up in the top right corner of your screen there. Do you agree with the market posture today? Do you disagree? If you click on disagree, comment down below on what you're seeing or what you think. Let's chat about it. Now let's talk about what's driving this price action today. Of course, the big news of the day, there really wasn't a whole lot on the economic calendar. Some job openings report came out that continues to show a lot of job openings there. So strong, continued strong job growth here going forward. So so that's really the only thing. It didn't really impact the economic surprise index. Is still at a relatively high level. Especially compared to globally, especially I think like right now in Europe, it's at minus 100. So you always have to put things in perspective and can't just look at, okay, well, our economy is not doing very well for whatever reason. We might believe it doesn't, because when you put it in comparison everywhere else, it continues to do very, very well. When you look at the odds for rate hikes, so the odds of getting that second rate hike, for September, or getting the one rate hike in June is pretty much 100%. Well, according to the futures, it is. So getting that second one now, you'll notice is about 95% chance of getting the second rate hike. That just a month ago was only a 50% chance. So the odds of getting the second one by September are pretty darn high. And then now the odds of getting a fourth one, which is would be here by the end of the year. So fourth one for 2008, looking at about 44% chance, and that's down a little bit from where it was a week ago when it was at almost 50, but still close to 50-50 odds that we'll get another one by this December. So nothing in today's announcement of this pullout from the Iran deal impacted that. In fact, over the last 2 weeks, you can see here that the dollar's been strong. Emerging markets have really, off of this low point where, stocks have really been kind of moving. You can see small cap stocks. In fact, if I were just to go back a few days, let me change the time frame on this one, say just back to the 5-day window here. Then you can see over the past 5 days, the small cap stocks has really been the outperformer. Crude oil also doing very well, and there's the S&P 500. And a lot of your high yield preferred stocks, foreign bonds, these interest rate long-term bonds, which is right there in yellow. You can't really see it right there. All these kind of interest rate sensitive asset classes are lagging behind, even with the strength in the dollar. You're starting to get some pickup here in the emerging today, having a pretty good day today. In fact, having the best day today. And if I were to go back now, just looking at a 1-year chart, emerging markets had the best day of the day, up. This is over 2-day period, but you can see up 0.5% today. Small cap stocks up 0.5%, even with the strength in the dollar. Crude oil and gold outpacing stocks. There's the S&P 500 developed markets, and then there's all your interest rate, the long-term bonds, high yield, preferred stocks, foreign bonds, all really lagging behind everywhere else. So again, kind of shows that there's still an appetite for risk in the riskier asset classes. 3 of the 4 top performers today are some of the more volatile, riskier asset classes in this particular group. All right, I want to focus on a few of these ratio charts here, and I'm going to first take a look at the stocks of commodities. You can see commodities are really starting to rally against bonds, against stocks. So this is stocks to commodities. You see how it's falling. You can see growth stocks, discretionary versus staples, small caps versus the Dow Jones Industrial Average, equal weighting versus the S&P 500. So the equal weighting is starting to pull back. So it's not necessarily mid caps, which is what this would represent more. But you're getting the small caps. And look at emerging markets, which have been declining but bouncing today. There's your U.S. stocks relative to foreign stocks, and of course oil versus gold. All of these are risk appetite relationships, and they're all continuing to point higher. So positive sign across the board that investors in different asset classes are willing to take risk right now. They're not looking at like today's news announcement, for an example, as geopolitical risks that would be seen as a flight to safety. Looking at the different sectors all at once, first of all, just looking at today, you can see the energy sector was our best performer by the end of the day. Financials, industrials also up, along with technology stocks, and there's your S&P 500 flat. So all the laggards you're looking at across the board, but a lot of these, I mean, there's your safe haven sectors right there. The bottom four are your typical safe haven areas. So again, another sign of risk appetite to a degree, right? You know, usually you'll see discretionary up there too, and discretionary is down a little bit. If you take a look at discretionary, you know, it's still above its moving average, and it's still got a strong intermediate posture that's rising. In fact, I mean, you take a look at the intermediate lines that are above, you know, above 70. That's where the market, that's where the S&P 500s is. You know, technology is above 70. It's rising. It's above an upward trending moving average. Energy, same thing, above 80 and rising, above its moving average. I mean, again, utilities has had a big drop, and you can see it starting to roll over again. Real estate, they've been kind of tied together. It's rolling over. Healthcare is rolling over from a falling moving average. You can see telecom over there. Staples continuing to lag behind below a downward sloping moving average. Industrial starting to show some relative strength, or starting to show some strength. Financial starting to show some strength. Materials getting above its moving average. So I mean, they have lower intermediate lines. So these areas are starting to make their way up. But your strength right now are in energy, technology, and discretionary, above upward trending moving averages, with strong intermediate lines that are all rising right now. When you look at the comparison chart, you can see, you know, energy really taking off on that Trump announcement. A little bit of a knee-jerk reaction, but then finishing the day strong. There's industrials. Financials started the day strong, held up that strength. You know, again, this is not coming from yesterday's close, so it doesn't include any gaps, but it does include, you know, this is from the open of today's market, and you can see down utilities just having the worst performance even before the Trump deal was announced, and especially after. And there's, you know, real estate, healthcare. You can see materials down here with these other consumer stocks all lagging behind the broad market as a whole. So risk on move, but it's kind of interesting that it's not, you know, discretionary and technology, which is usually those two kind of go hand in hand, or it's not energy and materials. Those two typically go hand in hand. It's technology and it's energy, as well as industrials and financials, which are usually kind of the third wheel in a bullish rally. So those, you know, those are the pockets of strength right now, and obviously a clear pocket of weakness in a sector that has been doing relatively well. You can see here's the XLU just by itself, and breaking below its moving average with a pretty strong volume today. So it's pretty bearish from that perspective. The intermediate line coming out of the reversal zone. Let's look at it on this market forecast chart here. There we go. We'll take a look at it right on the 1-year daily chart. So you can see, let's take a look at XLU again. The intermediate line really coming down pretty sharply, coming below that moving average. Stochastic, or the momentum falling below an extreme low point. The near-term line coming down without getting into the reversal zone, so coming down from what would be a bearish high point, making its way, and there's your spike in volume. So not a good sign for the utility sector, you know, after having, you know, a few months of relative strength here. One stock that's in one of those sectors that's showing, starting to show some signs of life in that financial sector is one I wanted to focus on, is Citigroup. Look at Citigroup kind of breaking out today, breaking above its moving averages. You can see the 8 and 17 day both rising. So the 8's not quite above the 17 yet. You can see the MACD is not quite above 0, but, you know, it's making a strong move well above its moving average. Same thing with stochastics getting above its moving average. Both lines giving you pretty good divergence opportunity right now. There's some opportunity here for Citigroup going forward. Very good strength here. So 3 green arrows. We have a 3 green arrow chart. 1, 2, 3. Excuse me. This is on S&P. Let's pull up Citigroup here. 3 green arrows on a spike in volume is a very good sign. And then this would be a very good sign for the market, of course. Still on a relative bearish trend. So that says, okay, well, what if we were to sell the $70 strike? And you notice the $70 at the bottom of this candle here. So if you see this line right here, where that line comes from, which would basically mean that we filled in the gap, comes from selling the $70 put and buying the 67 as a protection, and then using that vertical spread here and putting the line around where the lines cross over, and you can see it's right where the green line would give me about a $69 loss at expiration. So anytime before that would be a little bit less, but that would give me about a 1-to-1 reward to risk ratio if we were to kind of fail this breakout move above all these highs and make our way back down into the gap. And you can see it a little bit better on an intraday basis here. You take a look, here's the 4-week range, right? So we're breaking up in the upper half of the range. So we have to break back down into the lower half of the range and into and through that gap before you get to a point where you've lost at least the amount that you're trying to make on this particular trade. So again, strength in financials today. That's one of the stocks one of the sectors that has outperformed the market over here on the left. Strength in financial, which had been relatively weak, as we saw from the sector comparison chart. It's one of the 3 sectors or so that's got a rising intermediate line, but below 50, so it's got opportunity for some growth and start to get pulled up here. And today's trade on Citigroup in particular, with the strong move and the strong volume, suggests that this one might be able to hold up above above that particular strike price that we have for this trade. You can see these old high points here also would be holding up at the top of the gap for some intraday support. So what do you think about tonight's trade idea, and as well as tonight's market posture? I want to chat with you about it in our Market Outlook forums. You'll see a link to it in the top right corner of the video that pops out there, as well as chat about any other trades that we've talked about in previous videos. Make sure you, if you haven't already subscribed to our site, do so you can participate in our forums. Remember to like, subscribe, and comment on the YouTube channel down below. Follow me on Twitter for more content throughout the day, as well as join our Market Outlook community on Facebook. Have a great evening, everybody. We'll see you all tomorrow.